The stock market might be preparing for a housing market collapse. Now, over the weekend, I ran into some videos and started doing some researching on these, deep diving into what they were talking about. Some analysts are pointing out specific stocks that, when you take a look at them, are significantly already undervalued based on what the value of their holdings are. Now, these are some of the biggest landlords in the United States. Some, number one, with 85,000 houses, and these are reduced in value by some 30%. Now, the stock market itself may be front-running what they think might be happening. Of course, my take is always simply this. We start with the economy and ask the questions, how will this affect the stock market? And specifically the housing market. Will we see a housing market bust? 30% decline, that would be significant. But when you take a look at how much the housing market has moved higher, it's reasonable to assume that we could potentially see a housing market decline in price. Now, I broke down some of the economic indicators that would drive the housing market, showing that we may actually end up looking at stagflation, and from that, certain stocks would move lower, housing prices would move lower. Now, the question I always have is, how can I make money in the stock market based on this information? So I'm breaking down the housing market in general. We have a bunch of economic indicators coming in from the housing market, which would help to kind of show what is potential there. The economy itself, regarding stagflation, we are seeing inflation. We're going to see more inflation, but we're also going to see slower growth based on some policy shifts out of Washington, D.C., and broadly speaking, the Federal Reserve making moves regarding interest rates. Breaking all this down, these stocks, which are overvalued to begin with, even though they're already undervalued relative to their book values, when you start taking a look at it, you're kind of looking at this saying, this could get ugly. Let's jump in. Starting off, for those of you who are just stumbling and finding my content for the first time, I'm an economist, and I apply economic indicators to the stock market, showing how we will see movements based on what the economy is telling us. I start with the position that the stock market is the end result, and from there, what is the cause? The economy is always the cause. There are certain economic indicators that would push the economy, and by extension, the stock market. Now, I'm doing a whole series of videos. I should have one out on Thursday regarding economic indicators and how they apply to the stock market. So you might want to follow along as I produce these videos. And there should be about 11, hopefully, over the course of one per week. We are looking at XHB ETF. And anybody who's been following me for any particular time, specifically, I think in January, I've put on a pretty decent sized position, XHB ETF. And I basically said that given some of the economic indicators, the stock market, broadly speaking, will move lower. XHB was one of my targets. When we look at tariffs, their effects on housing, XHB ETF is a housing ETF, homebuilders ETF. There's some actual home builders, the guys who are swinging hammers, building an actual home. And then there's also suppliers. You've got Trane, you've got Williams-Sonoma, just a bunch of different kind of companies that would provide for appliances and things like that inside a home. And that's where XHB ETF kind of comes in. There's more than one. I like XHB ETF, but there's a couple out there. There's 4 actually that I've been able to find on the etfdb.com. I took a short position in January. It's doing okay. Bottom line, I think it's going to do a lot better. But let's move forward to the one stock where this one was the highlight. This is the country's biggest landlord, 85,000 homes, which when you value the homes themselves, the stock itself is valued about 25 to 35% of what those home values are given the price of each home. 85,000 homes is nothing to shake at. And on the one hand, INVH stock, I'm not trying to make a video on INVH stock as much as I am the housing market with home builders. We got economic data coming this week and next week. This is about the period of time. It's about late second, early third week of the month when we start getting into the fourth week, when we get key economic indicators for the housing market. And again, I am going to put a video out probably next week on housing and how housing would affect the U.S. economy and by extension the broader stock market. INVH stock itself, how much is it worth? This is the first question you're going to ask. And when you break down, say, price to earnings, this stock is way overpriced. But they also have book value. Their book value is significantly underpriced. From earnings alone, I would cut this stock down to, I'd pay 12 to 17 on INVH stock when you look at it. Maybe that's a little low. You meme stock players might want to kind of look at this and sit there and say, well, I bet we can bust 10. I don't know that we're going to get that low, but let's ask some basic questions. Forward earnings. If you look at the next 4 quarters, they're looking to earn about 73 to 75 cents earnings per share. What would you pay for that? Your current price at $31.69 gives you about a 2.25% yield. That's pretty low. That's a lot of risk. When you couple that, when you break down what's going on with the stock market itself, the housing market, the economy, $31.69 is really rich, but they're holding so much assets that are undervalued. Is the stock market, are the the stock market players, are they turning INVH into a meme stock and pushing lower, thinking, hey, the housing market in general is going to take a hit, and this is our poster child because they're the biggest. There were other stocks that I ran into based on some of the economic data and some of the videos I ran into, and there was a bunch. I fell into a black hole over the weekend, and I was like, man, that doesn't sound right. Oh, look at that number. Oh, wow, really? And then forget about it. I blanked several hours. So INVH stock, again, earnings per share, you're looking at 73 to 75 cents. How much would you be willing to pay for that? First and foremost, the 10-year Treasury yield is yielding 4.52%, I think, at the time of this recording. Looks like it wants to go higher. And with inflation the way it's moving, probably will move upwards to, say, 4.6, 4.7, 4.8. I don't know that we cross 5% on the 10. There's not much risk involved in the U.S. 10-year Treasury at this point, especially with the CEO trying to slash the budget as much as he can, which reduces risk on that. I don't know that we're necessarily going to breach 5% on the 10-year Treasury. So that's a fairly safe investment, AAA rated. But if you think about it, eventually interest rates will move down. So if you bought in the 10 at, say, 4.6, 4.7, eventually we see the 10 down to 3.5. You're sitting on some value. So given that, 2.25% on INVH stock with a future earnings potential, yeah, I'm not buying that. Let's break down some of Invitation Homes metrics. I just did a quick, again, I'm not trying to do a poster child here, Invitation Homes, but I think they are probably likely going to draw in a lot more of people who are target practicing. I'm short XHB ETF, realizing that the housing market is going to take a hit based on several metrics. The valuation of the homes are likely to decline. The stock market itself, stock market players are taking aim at Invitation Homes because of that. And while I was on the right track for certain reasons and am profitable on my short XHB ETFs position, Invitation Homes just sort of A, reiterates it, B, makes me sit there and say, can I make a buck off this? And I got if you stick around the very end, I've got the options pricing that I can show you that makes this kind of interesting. But when you look at these metrics, assets, liabilities, price to earnings, those were huge. And this is not an economy where you can sit there and say, listen, this stock market is just going to keep rolling and rolling and rolling. I don't see how that possibly happens. I've already said, like with your legacy stocks, the Dow 30, I see a tough time with the Dow heading higher. And I think we're only one comment or one policy shift or one economic indicator away from reality hitting the stock market that we're going to see things moving lower. So in this case, total assets, their assets are, when you price the 85,000 homes, these assets are already declining, even though you can see that there is a gradual increase. But those house prices are likely to be pushed lower. Here are your bullet points that I really want to take a look at. Stagflation. This is a concept where we continue to get increases in inflation prices, but lower growth. We are very likely at the point where we could see stagflation begin. We just got inflation data points, which rocked the markets, the stock markets a little bit there. And I've said, if you've been following me since all the way back in 2023, I sat there and said, 2024, the Federal Reserve does not lower interest rates. In fact, we're going to have big issues with the economy because this economy is too robust, and the Federal Reserve doesn't have that room to lower interest rates. The Federal Reserve lowered interest rates. I was dead wrong on that, not because I believe the economy allowed for it. I think the Federal Reserve was tipping their hands to a presidential candidate. They started lowering interest rates in September, and I've been stammering for quite some time. Too early, too soon, too much. We are now getting inflation data that suggests they should not have lowered interest rates. With policy shifts coming out of Washington, D.C., they may have to raise interest rates. Again, reiterating, I said in 2024, with a presidential election, with the economy the way it was, they can't be lowering interest rates. They did anyway. Now they may have to reverse that. But one of the things they can do is remove policy accommodation via quantitative easing and letting their balance sheet drop significantly. That would choke out the economy. In the meantime, we're seeing price pressures. We just saw those inflation numbers moving higher. Tariffs will push prices higher. Tariffs are a tax. That is reality. All prices that we're seeing are going to be moving higher. So that tax removes money out of the system, which actually kind of gives the Federal Reserve the ability to do nothing, simply because by the federal government stepping in and removing money out of the system with a fractional banking system, you can't see perpetual growth in the money supply. That's one thing that I'm actually kind of keying in on and want to keep a good eye on as to how that plays out. It will take 2, 3, 4, 6, 9 months till we see the real effects of these tariffs hitting the economy and how that shrinks the money supply, the growth rate of the money supply. So on the one hand, tariffs will push prices up. On the other hand, those tariffs will remove money out of the system. It is a sort of 1-2 punch for the economy. Higher prices, lower consumption, because you have finite incomes. Only so much money can be spent in one direction or another. Because of that, the federal government is removing money out of the system, which means less liquidity, which means the economy slows down. The M2 money supply is the fuel that keeps this thing running. If you start vacuuming money out of that system, it doesn't run. So we'll see lower consumption, we'll see lower growth. But at the same time, we see higher prices. We're also going to see unemployment numbers. Start paying attention to Thursday morning initial claims numbers. Federal government's laying off thousands. Not a huge number. Mind you, we just printed 143,000 new jobs in February, actually January, but we printed in February. What exactly does that mean? That's Biden. That was the end of Biden. That was printed in February from January. Now we're getting late January, early February's effects, policy shifts occurring in the stock market or in the economy, and that will affect things. You'll start to see increases in initial claims every morning, 8:30 in the morning, New York time. The Department of Labor starts releasing initial claims. It's a bit of a sleeper right now. It will move higher, plain and simple. Anybody who just lost their job, they'll file for unemployment insurance. We'll actually be able to track that on a weekly basis. Those who continue to be on the unemployment insurance programs will be counted in the continuing claims. So you have the ability to track that in real time. But as we see unemployment continue to increase, even a little bit, just a little bit, economic activity, broadly speaking, growth slows down. So you're getting higher price pressures, you're getting higher unemployment, growth is slowing. We are staring stagflation in the face. And the next thing to happen with there is, with higher interest rates, because the Federal Reserve does not have the ability to lower those interest rates, this affects the economy as well. Costs increase from borrowing costs. Your 30-year mortgage is, I think, 6.9. I've got that chart here in a second. We're going to see no more growth effectively. We're going to see higher unemployment, but we're also going to see higher costs. All right, here's your U.S. 10-year Treasury yield, and it is sort of moving higher. I think 4.52 is the 10 right now. Here is, I just grabbed this real quick, bankrate.com versus the national average for the 30-year mortgage rate. Kind of gives you an idea. And 6.9 was the 6.92, I think, was the number on there, and that gives us an idea that historically we had been lower. Maybe 4.5 to 5.5 is a solid median from, say, the past 20 years, but we've had a lot of economic roller coasters thanks to the Fed. The dot-com recession, which that was over zealousness with the dot-com era stocks. Then we had the financial crisis. Then we had COVID. And the Federal Reserve has stepped in consistently and just throttled this economy with the money supply. We're paying for those consequences. Here is the median sales price of homes versus the M2 money supply. The money supply effectively, when you see the real number expanding, moving higher, growing, whatever it is, assets do exactly the same thing. This is one of the key economic indicators that you need to follow if you want to understand what's going on with the stock market. The money supply is, there are policies that drive the money supply. So the money supply is actually the effect, not the cause. The Federal Reserve is looking at the economy and they either floor it or hit the brakes. But they're the ones who are really steering things, and they drive the supply of money. And as you can see from these charts, the supply of money and housing prices move fairly close in hand. Generally speaking, a strong correlation. I've been saying that the money supply growth rate is a problematic situation right now, and the Federal Reserve is going to need to step in and make some adjustments. Because of that, I believe that the Federal Reserve should not have lowered interest rates, but will force this economy to slow its growth rate in order to contain price pressures. The money supply will be one of the casualties on that. You will see a decline in the money supply, by extension, home prices. Going back to Invitation Homes and stock market players front-running a decline in the value of Invitation Homes. There are a couple others. Again, I'm not trying to make a poster child of that particular stock, but gee, that sure is interesting for you meme players. I'm short not SMA, XHB ETF and taking advantage of it at the same time. Core inflation, just wanted to reiterate this. We got this number just last week, and 3%, crossing the 3% threshold. Again, not hitting the 2% target rate the Federal Reserve is targeting. New housing numbers, we're going to be getting new housing numbers. I think that comes out next week. We get existing home sales this week. We get building permits, I believe, very early next week. So this period of the month, I guess this is the third week of the month going into the fourth week of the month, is when we start to see housing economic indicators and how that would potentially affect the stock market. Right now, it's kind of a sleeper that the savviest are stepping up forward and sitting there saying, listen, we're staring stagflation in the face. Anybody who's sitting on a house, your home price is very likely to decline significantly. Maybe not a good time to be buying a house. And if we start to see these valuations kind of shift lower and housing prices shift lower, people will step back, especially since housing prices are declining, but interest rates are continually moving higher based on inflationary pressures. Building permits, again, I think this one hits Monday. Not the most crucial economic indicator that would affect the stock market right now. But these, and this is part of what I do on my content, is keeping the information ahead of the curve. That those who are following me sit there and say, listen, I understand that there's some issues going on with the housing market and the cause and the effect, and because of that, how we will likely see shifts in the economy and what that means for the stock market. Eventually, the less savvy will start to stepping in and sitting there realizing, oh, look at the housing market, look at these ETFs for the housing market, look at these individual stocks, and that's when you start to see moves that are too late. You've already missed sort of like the icing on the cake. Again, Invitation Homes, here is their big chart. And what I wanted to really kind of look at, I think I'm going to go ahead and bite on this one. This is, I pulled this out of my Webull account. You can see puts and calls. Puts are trading $25 put, 27.5 puts are trading at about $1. And this is for October. So we go back to the valuation of this stock and we ask the question, how much are they making? At $31.69, I think was Invitation Homes stock price. $31.69, that's a bit rich considering your only yield is going to be 2.25%, given what they could potentially earn. But are they even really going to earn that? Anybody who's swinging a hammer, they stopped swinging and they started running. Yes or no? I mean, the countless videos I've been seeing where individuals, company owners are saying, listen, I don't have any roofers. I don't have the ability to fulfill my obligation of roofing. This is kind of across the nation. So can Invitation Homes even hit their revenue goals? Without their revenue goals, how are they going to hit their profits? At the same time, they've got 85,000 houses which are being valued by the stock market as much lower. Now that's actually kind of like, well, maybe the house prices just continue to move higher. I'm at that point where I'm starting to eye up a lot of puts on a lot of QQQ puts, things like that. Sitting there saying, it's done, it's over. There's nothing in this economy that will continue to push the stock market higher and higher and higher. And because of that, we're likely to see a broad-based sell-off, even if it's a snowflake turning into a clump, turning into a snowball, turning into an avalanche. This is the beginning of it. these individuals who are looking at house prices, who are looking at mortgage rates, who are looking at costs involved, sitting there saying these house prices are too high. We're in a stagflation situation. These economic indicators are pointing out that we're going to see asset devaluations because there's too much inflation and there's more on the way with tariffs. This is the beginning. The savviest who start to get in on these things and think ahead will get the biggest gains. And I'm sitting there looking at that 27.5 option at $1. I think I might hit that. For October, this is February. You only want to charge me $1 to sit on a 27.5 put on Invitation Homes, which is, in my opinion, based on what they could potentially earn, which is overvalued at that price, is half. Like I could easily, if you said, yeah, at the end of this year, Invitation Homes would be sub 20, I would be like, yeah, I can see that. But if we see that big shift, then what the assets that Invitation Homes is sitting on, the housing market decline in prices, 35%, that's very realistic. That's huge. Think of what that does to the stock market. If you start putting these pieces together, you're sitting there looking at that 27.5 put option for October at $1. What do you have to mortgage? I'm going to be putting out a housing market sort of analysis, taking a look at the entire housing market. I'm going to do it next week because we are going to be getting all the economic data on housing market for this month. So I'll put that out next week, a video on that, plus a full description, written post on my Substack. Make sure to follow the links down below at the end cards with regard to that. Again, this is a whole series I'm going to be putting out so that you can kind of take a look and figure out what's going on with the economy, the economic indicators you need to follow in order to better understand the stock market. And what I try to do is explain all that and show you how the stock market moves and how to make money in the stock market based on that. Make sure to hit that like and follow button. Push over to my Substack. I actually have dhtayloranalysis.com. That website page is now up and running, and Substack defaults to that. So we'll see you in the next video.